There's another look at major North American markets where you can see, at least in Toronto, the positive sentiment has increased in the first 4 minutes now of trading. 4 minutes into the trading day, Toronto up by about 1/4 percentage point. The S&P 500 has also magnified its advance. It's up by about 1/5 percentage point. The NASDAQ composite is up in by a smaller degree, and the Dow is up by about 1/3 percentage point. Well, everybody is talking about the potential of big tariffs in the United States. Our next guest is a veteran money manager in Canada. She says the tariff threat is not as simple as it may seem, but she is staying away from companies that ship items across the border. Diana Avigdor is portfolio manager and head of trading at Barometer Capital Management. Diana, thank you, as always, for joining us. What's your takeaway on this threat from Donald Trump, and what type of stocks are you perhaps avoiding as a result?
Hi, Paul. Thanks for having me. Yeah, it's not that simple, is, I guess, the bottom line. We have to remember, however, that there's lots of goods that the U.S. buys from Canada that it needs. Things like oil and gas. Cars make up a big chunk of what the U.S. buys yearly from Mexico and Canada, and it accounts for about 12% of our exports in this sector. So we know that Trump likes to use things as negotiating tools. In 2019, the U.S. announced a 25% tariff on steel imports and 10% on aluminum for most countries, then lifted the restrictions for Canada and Mexico in exchange for favorable terms as part of the three countries U.S., Mexico, Canada agreement deal. A week ago, Trump tweeted the benefits of Keystone Pipeline. U.S. imports about 3 million barrels per day of heavy oil used in their refineries. They can't change those refineries. They will continue to need that heavy oil. It will not go away. So it's curious what he's thinking about when he tweets 25% tariffs. That will hurt Canada, but will also hurt the U.S. So for now, we will stay away from companies that move things through the border, such as Saputo or Maple Leaf Foods, and stick with companies that service to the U.S., such as engineering companies, for example, that give service over the border. We're overweight financials. When you look at what the market has told us since the election, you see financials holding in very, very well on both sides of the border. So we're going to stick with things like, yes.
Sorry, what about shippers, Canadian shipping companies like the two big railways that both have very significant operations running into the United States, and the trucking companies, a company like TFI perhaps that moves goods into the United States? Do you have any thoughts there?
Yeah, those are a little bit more complicated. We think that overall trade size will continue to stay between the two countries. So we think that we don't have that much risk on that side. We prefer things like, industrials, financials, things like insurance companies, Manulife and Sun Life, again, not moving goods across the border.
Okay, let's resume. Let's go back to a sector that you mentioned a brief time ago. That's the financials. I believe it's the largest sector weighting at Barometer. On behalf of clients, you are bullish on both Canadian financials and U.S. financials. In Canada, you are holding, on behalf of clients, Royal Bank, CIBC, and National Bank. In the U.S., it's Goldman Sachs, Bank of America, and J.P. Morgan Chase. So you've got 6 major financial stocks held on behalf of clients. Why so?
Well, we think that the financials are going to benefit from, think of economic growth. We have a North American economy that is just chugging along quite nicely. Despite the fact that we may have a lesser decline in interest rates than you would have expected. But think about it from the perspective of That's a good problem to have, because the reason you're not having interest rates coming down is because the economy is doing well, employment is doing well, mortgage originations are going to pick up, loan losses are probably going to be brought in to the revenue line, and so we think that these financials are going to do well. But most interestingly enough, and most importantly, financials since the great financial crisis have basically been rendered utilities, given the amount of regulation that has been put on this sector. With that being loosened up, we think the financials are going to have a boost to your bottom line. I mean, there's a lot of sectors that have done very well. I think private debt that has moved away from their balance sheet. So we think the regulation story, or the deregulation story, is very important to the sector.
Diana, thank you for everything and have a great weekend. She is Portfolio Manager and Head of Trading at Barometer Capital Management.